What if I told you that the biggest financial story of the year isn't inflation? It's deflation. Not the kind that crashes the economy, but a very specific kind. A powerful force hiding in plain sight that is causing rent prices across America to crash. And this isn't bad news. For the savvy investor, this rent deflation is the single most important signal the market has given us. It's the trigger that just forced the Federal Reserve to change course. And in doing so, they've unlocked a massive opportunity in three specific types of stocks that are now coiled springs ready to explode. Stay with me, because by the end of this video, you will understand this shift better than 99% of investors and know exactly how to position your portfolio. If you want to jump to a specific section, we have chapters enabled in the description and on the timeline below. Let's get into it. So, what exactly is this rent deflation? Put simply, it's the year-over-year decline in rental prices, and it's being driven by one single factor: a massive, unprecedented surplus of new apartments. Think back to 2021 and 2022. The pandemic triggered a race for space. Everyone wanted a bigger apartment, a home office. Demand skyrocketed, and developers responded. They started building apartments at a historic pace. At the peak in early 2023, there were over 1.1 million new apartment units under construction in the US. That was a 40-year record. But here's the problem with construction: it has a long lag time. All those buildings, started 2 or 3 years ago, are all being completed and hitting the market right now. In the fourth quarter of 2024 alone, nearly 125,000 new apartments opened their doors, and the market simply can't absorb them. For 5 straight quarters, the percentage of new units that were leased within 3 months has been stuck below 50%. That's the worst absorption rate we've seen since the 2008 financial crisis. It's a simple case of supply and demand. When supply dramatically outstrips demand, prices fall. And are they ever falling? As of this September, the national average rent saw its steepest monthly decline in over 15 years. And this isn't happening everywhere equally. It's a tale of two Americas. In oversupplied Sunbelt markets that boomed during the pandemic, cities like Austin, Denver, and Phoenix, rents are in freefall, down 3 to 5%. But in supply-constrained markets like Chicago and San Francisco, rents are actually still climbing. This divergence is critical, and we'll come back to it. But the national trend is clear: the great rental boom is over. Rent deflation is here, and that brings us to the Federal Reserve. For the past 2 years, the Fed has had one enemy: inflation. They raised interest rates at the fastest pace in decades to cool down the economy. And it worked. Mostly. Inflation for cars, for electronics, for food, it all came down. But one stubborn component refused to budge: shelter. You have to understand how important this is. The cost of shelter, which is mostly rent, makes up 1/3 of the headline Consumer Price Index and over 40% of the core CPI, which is what the Fed really watches. At its peak, stubborn shelter costs were responsible for nearly 2/3 of all core inflation. It was the one thing preventing the Fed from declaring victory. Now, here's the tricky part. The government's official shelter data lags behind the real-time market by about 18 to 24 months. This is because of how they collect the data and because most people are on fixed one-year leases. So while we in the real world have been seeing rents fall for months, the Fed's official data was still showing shelter inflation stubbornly high, at over 5% for most of 2024. This tied their hands. They couldn't cut interest rates while their primary inflation metric was still flashing red. But now, the dam has broken. The real-world rent deflation is finally and powerfully showing up in the official numbers. CPI shelter inflation has plummeted from a peak of over 8% down to just 3.8% as of September. This is the holy grail for the Fed. It's a powerful, organic, disinflationary force. They don't have to crash the job market to get inflation down. The apartment construction boom is doing the heavy lifting for them. And this is exactly why, in September of 2025, the Fed finally pivoted and cut interest rates for the first time in this cycle. Rent deflation gave them the green light. And that single decision changes everything for investors. We're about to dive into the 3 specific sectors that are primed to benefit. But first, do me a favor and hit that like button if you're getting value from this analysis so far. It tells YouTube that this is the kind of in-depth content viewers want. Now, let's talk about where the money is going to flow. So the Fed is cutting rates. Why is this such a big deal? Lower interest rates act like a lubricant for the entire financial system. It becomes cheaper for companies to borrow and invest. But most importantly, for stock valuations, lower rates change the math on future profits. When you value a company, you take all of its expected future earnings and discount them back to what they're worth today. The interest rate is a key part of that discount formula. A lower rate means those future earnings are worth more today. And this effect is not the same for every company. Some stocks are far more sensitive to this change than others. These are the stocks we're targeting. Our first and most explosive category is non-profitable, high-growth technology stocks. This might sound counterintuitive. Why would you want to own companies that aren't even making money? The answer is something called duration. Think of it like a bond. A 30-year bond is far more sensitive to interest rate changes than a 2-year bond. Growth stocks are the same. A company that isn't expected to be hugely profitable for 5 or 10 years has a very long duration. Almost all of its value is tied up in those distant future cash flows. When interest rates fall, the present value of those distant earnings goes up exponentially. This is why these are often the first and most aggressive stocks to rally when the Fed signals a pivot. We're talking about companies in sectors like cloud computing, biotech, artificial intelligence, and fintech. These are businesses that are burning cash now to capture massive market share for the future. Just look at the Magnificent Seven. After the September rate cut was announced, some of the group's prior laggards, like Tesla, surged double digits in a single week. Investors were immediately repricing its long-duration earnings stream. And look at a company like Nvidia. Over the past year, as the market began to anticipate this Fed pivot, the stock is up nearly 50%, while more traditional, economically sensitive stocks have been flat or down. This isn't just about AI hype. It's a textbook example of the duration effect in action. The takeaway here is that portfolios that are overweight in these high-growth, long-duration technology assets are positioned to outperform significantly during a Fed easing cycle. This is where you find the potential for explosive, multi-bagger returns. This tech rally is exciting, but it comes with high volatility. There's another sector that benefits from rate cuts but also pays you a steady dividend while you wait. Before we reveal it, let me know in the comments, which growth stock do you think has the most upside from here? I read and reply to as many comments as I can. Okay, let's move on to our second investment. Our second category is residential real estate investment trusts, or REITs. Now wait a minute. I just spent the first half of this video telling you that rents are crashing because of an apartment oversupply. Why on earth would we want to invest in apartment owners? This is where that geographic divergence we talked about becomes the key to making money. Not all REITs are created equal. You see, REITs are highly sensitive to interest rates because they use a lot of debt to buy and build their properties. When rates fall, 2 things happen. Their cost to borrow goes down, which immediately boosts their profits. And it becomes cheaper for them to acquire new properties, allowing them to expand. But the fundamental business still has to work. That's why you want to avoid the REITs that are heavily concentrated in those oversupplied Sunbelt markets we talked about. Instead, the opportunity lies with the premium, blue-chip REITs that own properties in the supply-constrained markets. We're talking about companies like AvalonBay Communities and Equity Residential. These companies own thousands of high-end apartments in markets like Boston, New York, Southern California, and Seattle. These are markets with strict building regulations, so they don't have a massive glut of new supply. They have strong, high-paying job markets, and people are still moving in. For example, Equity Residential just reaffirmed its guidance for solid revenue growth this year, and its buildings are at 96.4% occupancy. These companies can benefit from the tailwind of lower financing costs, while their actual rental income remains strong and stable. This is a more conservative play than high-growth tech, but it offers a compelling combination of price appreciation from the rate cuts, plus a reliable dividend yield, which is typically in the 3 to 4% range. Our final category is a recovery play. It's a sector that has been beaten down and left for dead, but is now a coiled spring, ready to be released by lower interest rates. I'm talking about home improvement retailers like Home Depot and Lowe's. These stocks have massively underperformed the market this year. Home Depot is down about 4%, and Lowe's has fallen over 10%. Why? Because their business has been frozen by high mortgage rates. For the last 2 years, nobody has wanted to sell their house and give up their 3% mortgage for a new one at 7%. This is called the lock-in effect. And because people aren't moving, the biggest driver of major renovation spending has stalled. At the same time, high interest rates on home equity lines of credit, or HELOCs, have made it too expensive for existing owners to finance big projects. But lower interest rates are the key that unlocks this entire logjam. When the Fed cuts rates, it eventually trickles down to lower mortgage rates. If mortgage rates fall back into the 5 to 6% range, that lock-in effect starts to thaw. People start moving again. New owners buy houses and immediately start renovation projects. Existing owners find it cheaper to tap their home equity for that new kitchen or bathroom they've been putting off. TD Securities analysts have called this a coiled spring of deferred demand. This won't happen overnight. It takes a few quarters for the Fed's cuts to fully impact mortgage rates, but this makes it a perfect recovery investment. You are buying into these high-quality companies at depressed valuations, just before the catalyst for their recovery kicks in. Analysts believe a company like Lowe's, which is more cyclically sensitive, could have an additional 12 to 18% upside from here if mortgage rates fall meaningfully. Okay, let's bring it all together. Rent deflation, driven by a historic apartment oversupply, has given the Federal Reserve the cover it needs to start cutting interest rates. This policy pivot creates a clear investment roadmap for the next 18 months. 1. For maximum growth, you should look to overweight, non-profitable, high-duration technology stocks. They have the most to gain from the valuation math of lower rates. 2. For a balance of growth and income, target high-quality residential REITs like AvalonBay and Equity Residential, which operate in supply-constrained markets and will benefit from lower financing costs. 3. For a recovery play, consider home improvement giants like Home Depot and Lowe's. They are the coiled spring set to benefit as lower rates unfreeze the housing market. The key takeaway is that the market is forward-looking. The time to position your portfolio for these changes is now, not after these stocks have already rallied. This rent deflation story is one of the clearest macroeconomic themes driving the market today, and now you have the framework to take advantage of it. If you found this analysis helpful, do me a huge favor and hit that subscribe button and turn on notifications. We release in-depth financial analysis like this every single week. Thanks for watching, and I'll see you in the next video.